Hello, Matthew Bell with InsurancePrescription.com. Today I want to talk through the difference between earned income and ordinary income. So first of all, taxes are complicated, and oftentimes tax preparers, and in fact anybody who's in a specialized industry, not just tax preparers, but they're going to use a specialized vocabulary, and when it becomes second nature to them, sometimes they lose track of how odd it seems to people who aren't in the know or on the inside. There's a number of different examples that could be given here, but in some cases it's a little bit easier to get a handle on some of the words, despite the fact that they are outside of the realm of what we hear in everyday speech. Sometimes they come to us in pairs. So for example, qualified, and I talked about tax qualifications and qualified accounts in other videos, but the point here is that you can contrast a qualified account with a non-qualified account. But what makes conversations about some of these words more difficult to even get a fix on or even start to get a handle on is the fact that in some cases you'll hear words contrasted with other words that seem to just come out of the blue sky. So for example, I've often run into treatments of some of these words where you'll see a difference made between ordinary income and capital gains. Well, the word ordinary and the phrase capital gains doesn't necessarily, obviously, in terms of standard American English, doesn't necessarily suggest itself with the same contrast as qualified and non-qualified. Due to considerations like this, I have personally found it difficult to get a handle on these words, and so from some of my research, I thought I would just share some of the things that I found out. Now, as a caveat, I am not a tax preparer, I'm not a financial advisor, I'm not an expert in any of these things. This is simply a layman's perspective, and I hope that you find something of value in what I've said, but all the time I would stress you need to check with tax preparer if you have specific tax questions, and certainly just take these as research leads and information pieces that I'm sharing. Mostly you can consider it for entertainment purposes only. So not to be construed as advice of any kind, and certainly I'm not an authority. But let me set the stage by saying that part of the reason this got raised to my awareness once again, this issue between ordinary and earned income, was because of the Secure Act. So the Setting Every Community Up for Retirement Enhancement Act of 2019, I've talked about it in another video, and I'll probably go more in detail in a future video. But for the time being, I'll simply observe that one of the changes that the Secure Act made was to traditional IRAs with respect to contribution time periods. So previously, the traditional IRA, you could contribute up to age 70 and a half as long as you had earned income, but not beyond that. But subsequently, with the Secure Act, you can actually continue to contribute to a traditional IRA after the age of 70 and a half, so long as you have earned income. So what's earned income? Let me lay the groundwork for this question by quoting from a few internet resources. So the first one, on the website InkFile, we read, quote, ordinary income is also called earned income. Now you'll notice that that statement is very close to suggesting that they're the same exact thing. But now a question comes from that, and we'll get to it in a minute, but let me just continue with this passage. So it says, ordinary income is also called earned income. As the name implies, earned or ordinary income is any money earned from your business activities or employment. It can come in the form of a salary, commissions, tips, or bonuses gained by working for someone else. It can also be income earned from your own company. Now, the upshot of the article in general was that there's a basic distinction in terms of earned and unearned, and the idea is that you can almost think of it in terms of activity versus passivity. So if you're earning the income, you're doing something, you're active, you're generating the money somehow actively, versus if it's unearned income. And remember, I said it's easier sometimes to get a handle on these words when we have a kind of complementary pair of them. So we had qualified and non-qualified. Well, earned income then can be contrasted with unearned income. It's income, but you didn't earn it. You didn't actively earn it through a job or something. So it came to you passively. So think about the status then of a distribution from an individual retirement account. Now here I'm thinking mostly of the traditional IRA, because the Roth IRA's distributions are going to be non-taxable as long as they're qualified, meaning in basic terms, you've had the Roth open for 5 years and you're over the age of 59 and a half. But if we think about an IRA, a traditional IRA, then the distributions are in principle taxable. But what's the status of the distributed money? Is it earned or unearned? When you think about it, the IRA's contributions, generally speaking, come from earned income. So you're earning money, and then you are throwing the money into the IRA. But the gain or the increase that might have accrued in that account, what's the status? Well, it doesn't seem that that has been earned. And so, in fact, it's interesting that the distribution from the IRA, the question is it considered to be earned income? Now, it's certainly ordinary income, and so it becomes a pressing issue going back to the InkFile article whether earned income and ordinary income come to the same thing, because it's certainly considered ordinary income. Let's take a look. Fidelity.com says quite clearly RMDs are usually taxed as ordinary income. Now, this is simply to say that when you take a withdrawal or a distribution from your IRA, you get a 1099-R for that tax year. You take it to your tax preparer, and the amount of the distribution in a traditional IRA context is simply going to be added onto your gross income. That, in general terms, that's what happens. And then you pay income tax on it at whatever your income tax rate is. But according to the Slot report, and Ed Slot is a well-known authority on annuities and this kind of thing, Slot tells us that to contribute to an IRA, you or your spouse must have earned income at least equal to the amount of your contribution. So here's the question then, basically. If earned income and ordinary income are the same thing, then shouldn't a distribution from an IRA be counted as earned income, which would then allow you to continue to contribute to an IRA? So in other words, you could just take your distribution out and put it back in. Particularly, this is relevant if the distribution is a required minimum distribution. If you've elected to take a distribution, then probably you have something else you want to do with the money, and you wouldn't think about putting it back in. But in the case of a required minimum distribution, where you're forced to take it out essentially by the Internal Revenue Service, the question is, can you just put it back in, or can you put it into another traditional IRA, or can you put it into a Roth? And of course the answer here is no, but then the question is, why is the answer no? And that's what I want to get into. So for instance, again, on Ed Slot's website, the article wasn't by him, but you can read pension and annuity income includes income from, and you can see here IRA, Roth IRA, company plan distributions, non-qualified annuity distributions, Social Security benefits, and all of those things do not count as compensation for purposes of determining IRA contribution eligibility. They don't count. What is the solution to this question? If a distribution from an IRA is counted as ordinary income, and if ordinary income just is the same thing as earned income, then this shouldn't arise. Getting a distribution should qualify you for making contributions, but it doesn't. So obviously the answer straightforwardly is that earned income and ordinary income are not the same thing. And it's quite true. Earned income is going to be income that is produced, let's say, gainfully from working actively at an employer. You're providing goods and services, and you're obtaining money from that active effort. So you might find some of the things that are going to be included in this, and you'll find things like commissions are going to be included, salary, tips, regular wages, and the like of this. But it may also include things like bonuses. This is all kinds of stuff that's going to be considered to be earned income. And once again, what the relevance here is that this is going to pertain to things like taxes. It's going to pertain to things like retirement vehicles. When can you contribute? What are your contribution limits? Because that's going to be framed around how much money you earn. It's going to be framed around what you can do with RMDs, where you can put these required minimum distributions. For example, let's say if you don't need the money. So there's a lot of applications here. So earned income, we just saw, included things like commissions and wages and bonuses and that. But earned income, depending on the context, is probably not going to include things like alimony or spousal support, child support, dividends, interest payments, rental income, retirement income, Social Security, unemployment checks, and the like of those. Now rental income is going to be its own separate thing. It's going to pose special problems. Rental income is going to depend. I'm not going to draw any hard and fast lines with respect to rental income. But essentially, even though it is true that your original contributions to your IRA were probably made from earned income, and so when those are returned to you in the distribution, those still presumably are going to be earned income. They were the money you got from when you earned that income. But the interest that's generated, or the earnings that that earned income was able to create, that isn't earned income. And so when you are given a distribution from an IRA, provided that you had some kind of a gain in that IRA, some kind of a gain in that account, the money that you get is essentially going to be a blend of earned income and unearned income. So the reason why it is not treated as earned income, presumably, is because of the fact that it has had a tax-favored status the whole time. So ultimately, we're going to come down to this, basically, that ordinary income is essentially any kind of taxable income apart from capital gains. And so capital gains are going to be treated differently. Capital gains are essentially going to be the profit that you make from some capital asset. But and capital gains are potentially taxed at a lower rate than your regular income tax. So you lose a little bit of favored status if the gain on your money in an IRA is treated as ordinary income instead of as a capital gain. But there's a trade-off, because obviously you were given a tax-favored status so that that money could grow the whole time. So the money in your IRA has been treated tax favorably. And so the idea here is that when it comes time to settle taxes up, the IRS is not going to give you an additional tax benefit on top of the benefit that you've already gotten by having that money in a qualified account where you were able to defer paying taxes all the years that you were able to do so. So in other words, the ordinary income treatment of a retirement account distribution is due to the fact that the tax bill comes due and you've been enjoying tax benefits on that account for many years, presumably, or at least for a few years. But let me sharpen up the distinction here between earned income and ordinary income. So the way I'm viewing this is something like a flowchart. So the first question you want to ask of any piece of income is going to be, is it earned or is it unearned? If it's earned, that is to say you obtain that money by working actively somehow, by exchanging goods and services or providing goods and services, then that money is earned. And if it is earned, then all earned income, as far as I can tell, is ordinary income. But some unearned income is ordinary and some is not. Now, the obvious point is that the contrast between ordinary and capital gains isn't intuitive. But if we can substitute the word, let's substitute the word extraordinary. Now, you don't usually hear about this, extraordinary income versus ordinary. But another synonym for ordinary income that you do sometimes read about is regular. Sometimes you'll read that ordinary income is called regular income. Well, then you have ordinary or regular income on the one hand and extraordinary or irregular income on the other. And the basic idea here is something that might be treated as ordinary income, even though it's unearned, are going to be things like an unemployment benefit, right? You didn't earn it. That's the whole point of unemployment, is you didn't actively work somewhere. So you got a benefit from something that you didn't actively work for. It's an unearned income. However, it's still taxed as ordinary income because it's a regular paycheck. It's a regular thing that you're counting on for at least a period of time anyway. Another idea here is going to be a distribution from a retirement account, your Social Security benefit. So these things, Social Security check, unemployment benefit, interest or dividends, these can be considered to be regular. They're things that you are getting on an ongoing basis. Now, on the other hand, certain things that are going to be irregular or extraordinary are going to be things like the sale of a capital asset. So the idea here is that you usually buy a capital asset, hold it for a while, and then sell it. And so when that happens, it is an extraordinary event. It's something that happens once in a while, occasionally, but not all the time. And so the idea, basically, if I understand correctly, is that a capital gain is going to be something that's taxed extraordinarily. It's an out-of-the-ordinary taxable gain that you have experienced, and you get a slight tax break because of the occasionality of that particular transaction. Now, some things that are they don't fall neatly into this would be things like gambling winnings. I mean, if you go to the boat one time and you win, you're still going to be taxed as ordinary income for your winnings, even though it was out of the ordinary. Let's say you have some debt canceled, go get a 1099-C. I've gone into this in other places. You'll get a 1099-C, and you're going to have to pay tax at ordinary income tax rates. And so even though that's an occasional thing, not everything falls neatly into this category. But I hope that something that I've shared at least maybe helps you get a little bit of a handle on some of these terms. I'll put the flowchart up on the screen, but I'll also post it on my website, insuranceprescription.com. So if you want to kind of think through it or look at it and kind of reflect on it, it might help to give you a little bit of clarity here. Now, I should just finally say that, so the first question was it earned or unearned? If it's earned, then it's ordinary. But if it's unearned, it could be ordinary or it could be extraordinary, or let's say a capital gain. And the list of income that is unearned but ordinary includes things like distributions from retirement accounts, Social Security, unemployment. But if it is unearned and extraordinary, that is to say in the capital gain situation, there are actually two possibilities there as well. And it is that it could be a short-term capital gain or a long-term capital gain. And in fact, if it's a short-term capital gain, in order to confuse things even more, it's going to be treated as ordinary income. And so a long-term capital gain is essentially the only treatment, the only tax treatment that's going to be different from an ordinary income tax treatment with respect to this conversation. There's also the question of whether or not certain distributions or dividend payments are qualified or not, but this is going to be beyond the scope. This is already convoluted enough, I know that. And this is why I wanted to kind of talk through it, because the thing that occurs to me is accountants and tax preparers get used to this language despite the fact that it's very dense and somewhat difficult to get a handle on. So I think it's of value for people to at least hear these terms and think through and to try to wrestle with them, because I think it actually brings home some of the meaning a little bit more. So I'm sorry that this has been kind of abstract and I'm sure very, very dense, but I hope what I've shared has been of value to you. If it has, I ask that you subscribe to the channel, click the like button, click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today, and I look forward to seeing you again in another video. Thank you.